Okay, good evening to all of you. I think it's good morning. Today we are going to start with the practice to pass session of paper financial reporting for September 22 attempt. So today we are going to discuss some of the key financial reporting standards that is important for this session only. So this practice to pass session is actually valid for September 22 attempt. That's a day-wise plan. Day one, today we are going to start with the final account. In day one and day two, we'll be focusing on the key IFRSs that will be most likely to be examinable for this session, along with the key changes that is important for September attempt. In day three and day four, we will be focusing on the consolidation. Day three will be based on consolidated balance sheet, and day four we'll be focusing on the consolidated income statement. In day five, we need to work on the ratios topic and along with the cash flow. And day six is an extra day that is available for us where we can do some extra practice or the area which we will not be able to cover properly. So it's a 6 days plan. So these are some key accounting standards that can be examinable in final account. But there are some very important accounting standards like IS 16, which is assumed to be most favorite accounting standard for the examiner for final account. Then we have IS 12, taxation, financial instrument that includes IS 32 and IFRS 9. Then IS 37, one of the key accounting standard that is important for this session. Then we have IFRS 15. So usually examiner will give you 3 to 4 adjustments from the final account. Definitely one adjustment will be from IS 16, second from IS 12, third would be from financial instrument, IFRS 15. For the fourth adjustment, there is a guesswork because the examiner can ask any accounting standard out of these, like IS 2 can be examined for the fourth adjustment. For sometimes the examiner can ask you about IS 38, intangible assets, or the examiner can give you the adjustment of IFRS 16, leases, or investment property, biological asset, non-current asset held for sale. So for the fourth adjustment, you need to do a lot of practice and a lot of accounting standards. You need to cover a lot of accounting standards because the fourth one can be examined from any part of the syllabus. So let's start with the basic definition of assets and liability. Like an asset is a present economic resource controlled by an entity as a result of the past event. So you need to learn this definition from the examination point of view. Liability is the present obligation of the entity to transfer the economic resource as a result of the past event. Equity is the residual interest in the assets after deducting all the liabilities. The reason we are discussing this these definitions because this is one of the past paper questions in which the examiner has asked that most of the students done this question, attempt this question wrongly. So I'm requesting you guys to please attempt this question for 1 minute. Like most of the students give the wrong answer of this question according to the past papers. Which of the following is not included in the International Accounting Standard Board definition of an asset? Controlled by an entity? Yes. Asset as a present economic resource? Economic resource can be measured reliably. No. Asset exists as a result of the past event. So the right answer is C for this question. But most of the students has selected option D. That's the feedback of the examiner's report. The right answer is C. Now, IS2 is assumed to be one of the easiest accounting standard in financial reporting standards, in which you need to know about the measurement principle of IS2. Right, inventory should be measured at the lower of the cost and net realizable value. And net realizable value can be calculated as expected selling price less expected cost to sell. And the cost, what is the definition of the cost? Is the cost bringing the items to their present location and the condition. So that includes cost of purchase, cost of conversion, and other cost. So here is a question for you based on the past paper and according to the examiner's feedback. Most of the students again attempt this question wrongly. So I'm requesting you to please attempt this question and reply your answer in 1 minute. You have only 1 minute to solve this question. D. We have 100 items having a cost of 14,900. Use. It is estimated that the work in progress would cost 13 per unit to complete, and that the each unit would cost them sell for 166. Direct selling cost at 2% of the revenue. In accordance with IS2, what is the correct value of the company's inventory? So what's the right answer? Right answer is A. The right answer is A for this question. So let's solve it together. It says that 100 items will cost you 14,900 to produce, and in order to calculate the NRV, we need to deduct estimated selling price. From the estimated selling price, estimated cost of completion and estimated cost of disposal. The estimated selling price is 166 into 100 units. So 166, 1660. Yes, 16,600. Minus estimated cost to complete is 1,300. So the work in progress cost here will be considered as the estimated cost to complete. And estimated cost to disposal is 166 multiplied by 100 into 2%. That's 332. When you calculate the NRV figure, it will give you the answer of 14,968. And as per the IS2, inventory should be measured at the lower of cost and net realizable value. So again, according to examiner feedback, that most of the students will not be able to attempt this question correctly. So, little bit tricky question, I think. So again, we have a question for you, in which two of the following statement regarding the company inventory are true? You need to identify which two items are true. You should the cost that we have incurred at the time of the valuation already should be the part of the cost, but the estimated cost that you need to incur in the future should be the part of the NRV. That's the number of special frames. These all are past papers questions. So you need to attempt these questions in 2 minutes at maximum. So what should be the right answer? The right answer is So this is how examiner give dodging in the examination. Why not A? Okay. It says that the frames will cost you 20,000 each and having a selling price of 30,000, and there is no estimated selling cost or cost of completion. So this will be considered as my NRV, and this is my cost. Now it says that due to recent technology advances, the current cost of manufacturing such frame is estimated to be 15,000. So this is my actually replacement cost. So IS 30, IS2 never tell you about the replacement cost. It only tells you about the cost that you have incurred in order to acquire the inventory and its estimated NRV. And whichever is lower should be the measurement basis. So need to value the inventory at the lower of cost and net realizable value. So this is one of the examiners' feedback that most of the students give A and E and gain 0 marks. Although half of the answer is correct, but you will not be able to get a single mark if your question is I didn't get it. Because the cost that is incurred after your order, you have already made those items for 20,000. Yes, where you are right. So this 15,000 will be applied for the new inventory when we acquire them for 15,000. So then it will be used as a cost. Now, government grant is one of the favorite accounting standard of the examiner with reference to, with respect to section A and B type questions. For 58,000, the cost is 30,000, 3,000 units into 20, 60,000, or NRV will be 21 into 3,000. 63,000 minus 5,000 is the estimated cost to complete this product. So the net realizable value is 58,000. Next part, government grant. You should know this, that the government grant can be revenue grant or a capital grant. Capital grant means the grant that we have received specifically for non-current assets. And all other grants which are not capital grant will be considered as a revenue grants. Okay? Revenue grants can be presented as the adjustment with the related expense, or it could be reported as a separate income like other income. Similarly, capital grant can be adjusted with the value of the asset, cost of the asset, or it could be recognized separately as a deferred income initially and released gradually in the income statement with the name amortization of the company grant. Remember this point, that for the capital grant, amortization will be based for the depreciable asset according to their method of depreciation. So the way you are depreciating the asset should be used for the amortization of the government grant. Now here is a question for you. According to the examiner, most of the student will not be able to answer this question correctly. So you have 1 minute to solve this question. what is the adjustment required to account correctly for the grant as at 31st December. So you need to tell the accounting entry along with the amount. P&L debit, liability, etc. So what we need to debit? It's the other income. Because we have received a government grant of 60,000 and there are conditions attached with this grant. So this will be recognized as income over a period of 5 years. But right now company has recorded the whole of the amount into the other income. So first of all, you need to calculate what amount of the government grant that we need to recognize in the current year. 60,000 divided by 5 into 4 upon 12. So that is 4,000. So actually the 4,000 is the amount that we need to recognize in this current year. So the remaining excess amount of 56,000 should be reversed and transfer this amount into a deferred income account. That is the accounting entry. So these are the questions according to the examiner's report that was considered to be the most challenging question, and most of the students give the wrong answer. On saying it's easy. Any confusion in this question, my dear students? Yes? No? Now, an entity received a government grant of 6 million on 1st January 2004 to keep the staff employed within the deprived area. The company must not make a redundancy for the next 3 years. The grant is to be repaid in full. By 31st December 2004, no redundancy have taken place and none are planned. So initially, you need to record the grant amount in deferred income, and in the current year, you have to release 6,000 divided by 3, 2,000 into the P&L. So, in the income statement, there will be an amortization of the government grant of 2,000, and on the face of the balance sheet, This deferred income needs to be split between current and non-current liability. So the current liability is 2000 and the non-current liability is also 2000. Very good. Now past exam question, Mill House Company. 1 minute to solve this question. So what's the right answer? It says which two of the following correctly reflects the accounting treatment for the government grant adopted by the Mill House in its financial statement. The Mill House received the government grant on 1st October 2008. The grant was held to fund the rental cost of the factory in an urban regeneration area. The condition of the grant was that the factory must be rented and used for at least 1 year. Mill House Company rented the factory from 1st July 2009 and was confident that the condition of the grant would be met. Mill House owns other factories in different areas. So from which date we need to recognize the government grant? From July? And nearly September. July, August, September for the 3 months. So recognize the 3 months government grant as other income in the statement of profit and loss. These are the 3 months government grant from the related factory expense. Yes, C or D is the right answer. So why A is wrong? It says full year. What about B?
Yes, sir.
Full amount. They read the full amount. I think it's easy to handle. Now IS 38. IS 38 tells you about the intangible asset. Please. Intangible asset should be measured according to the provision of IS 38 except goodwill. Because goodwill should be dealt with according to IFRS 3. So the purchased goodwill should be recognized as an intangible asset. And the negative goodwill will be recognized as a income of the business in the P&L. That is my non-current asset. Self-created, internally generated goodwill are not allowed to record. Secondly, the goodwill cannot be amortized over its useful life. It should be checked for the impairment annually, according to the provision of IS 36. One more point, goodwill and brand and other similar assets are actually unique assets where they don't have the active market. So you cannot revalue these type of assets. So one cannot revalue the intangible assets like brand, like goodwill, like similar type of assets. But if your intangible asset is of type where we have an active market like software or license, then in that case you can revalue these assets. So intangible assets can be acquired or internally generated. So we are not allowed to record the internally generated intangible assets. Only purchased intangible assets can be recognized. All intangible assets having a limited useful life should be amortized, except the goodwill. Research and development, research costs should be recognized as an expense in the income statement, and development costs should be capitalized if it meets the capitalization criteria. Otherwise, it should also be charged in the income statement. Now, here is an OTQ style question in which you will be having three projects, project 1, 2, and 3. The first point is, which two of the following are required by IS 38 intangible asset in relation to the amortization of the intangible asset excluding goodwill? So it's a general question. It is not connected with the scenario. So we are just attempting this question before reading the scenario. Intangible assets should be amortized over expected useful life and not at all if the useful life is deemed to be indefinite. सही है? ठीक है. Intangible assets should not be amortized, but instead review for the impairment losses. Can you tell me about the provisions for the impairment related to IS 38? It says there are three types of assets which should be reviewed for the impairment annually. The first one is the goodwill, intangible asset with an indefinite useful life, or intangible asset not yet available for use. So these are the three types of assets that needs to be reviewed for the impairment annually. Intangible assets should be amortized on the basis of expected pattern of the consumption of the expected future economic benefits. Intangible assets should not be amortized or impaired and instead simply carried forward at the original cost. So the right answer is A and C. Now, the next question is related to the scenario. No, it's again a general question. Which two of the following statements are true in relation to IS 38 intangible assets? So C is the right one and D is right. So A is wrong because there is no clear choice in IS 38 about the selection of revaluation model. Revaluation model can only be selected when there is an active market and does not permit the revaluation model, so that's why it's wrong. So right option is C and D. So these all are past papers questions. So this particular question is related to project 324. So in accordance with IS 38 intangible asset, what is the charge in the statement of profit loss? So what amount we need to charge into the income statement in relation to project 324? Now it's the time to read project 324.
That's 3.75.
3.75 कह रहा है 5.5 कह रहा है So the right answer is 5.5 million. So let's check the answers first. The right answer is A. So the question says that we have incurred 15 million from 1st April till December. And the expenditure meets the capitalization criteria from 30th June. So before 30th June, it needs to be charged into the income statement. So 15,000 divided by 9 multiplied by April, May, June, 3 months. 5 million should be recognized into the income statement and remaining 10 million needs to be capitalized. But this capitalized amount will amortize from 1st January.
5 years.
Divided by 5 years into 3 by 12. Till the year end, it's been 3 years, 3 months that we are depreciating or amortizing this intangible asset, having a value of 0.5 million. So the total amount that needs to be recognized in the income statement will be 5.5 million. 3 by 12. No. From June onwards, the expenditure needs to be capitalized. But the project was completed on 31st December. From 31st December till March, we need to amortize this capitalized development cost. Huh. So it's mentioned here, na? The project was completed and began to generate revenue from 1st January. Yes. It is estimated the project will generate revenue for the 5 years. So the next. Now, this question is related to project 325 and 326. Yes. According to IS 38, you need to amortize the capitalized development cost from the date when you are getting the benefit from that particular expenditure. So from the date when the active production starts, so it will be counted as a amortization date. So right now we are focusing on project 325 and 326. So please read these two projects. So this is the technique through which you attempt the OTQs. Now you don't need to read the full question from the first time. You just go and first check the questions attached with this OTQ. So sometimes there are neutral questions that have nothing to do with the scenario, like question 1 and 2. But for question 3, it says that you need to go and check the project details of 324. Then we are reading the scenario. So every OTQ will be based on 3 to 4 different type of questions. So project 324 and 325. Cost 20,000 per month incurred till then when the project was abandoned. So let's attempt the question. True, false, true. True, false, false. What's your answer? I didn't read the question carefully. Research. Okay. Yes, first वाला true हो जाएगा और बाकी दो false false हो जाएंगे. सही है जी. देखिए लास्ट वाले के अंदर वो कह रहा है कि आप the criteria of IS 88 are not met because the director had not been confident for the success of the project. So that's why that means that the criteria are not met. So we cannot capitalize this. Now here is a question for you. Abandon means that you have stopped using this particular asset or the Which of the following costs would be capitalized as an intangible asset? So for 400,000 is staff cost incurred in updating the computerized records of the potential customers. We never capitalize the staff cost. 800,000 for the purchase of the domain name for the website. Yes, it needs to be capitalized. 4 million for the patent purchase to improve the production process. Yes, it's also capitalized. The right answer is C. So now here is a question for you. That exam past paper question. Oh, it says the right answer is A. Okay, should we solve it?
Yes.
The cost relates to the evaluation of the alternatives to improve the production systems to implement during 2005 and 6. The company spends 1 million on related salaries and material of 2 million on design equipment, which has an expected life of 4 years. Project 2, it says that they involve the testing of a new product which will introduce to the market in 2005. It is expected to generate profits over a period of over 4 years. The company spent 4 million on salaries and materials and policies to charge the full year's depreciation on the assets. So from the project 1, what amount we need to capitalize and charge in the income statement? 0.5 million plus 1 million and 4 million from this value. And the right answer is 5.2.
तभी 4 million पूरा क्यों लेते हैं इसी साल में?
Actually, this 4 million is actually related to the testing of the new product. That's about research. So we are doing research of 4 million. So that's why we need to charge the full amount in the income statement. Salaries and material is an expense because we are doing the research now.
डेवलपमेंट में आएगा ना क्या?
Which one?
प्रोजेक्ट
No. Involve the testing of the new product which will be introduced to the market in 2005 and is expected to generate profits over a period of 4 years. On salaries and material, the policy is to charge the full year depreciation on the asset. So the testing, if you are doing some testing, if you are doing some uh, study to gain the knowledge, so that is the part of the research. So again, a mixed question that is related to IS 38 and 4020.
और 50
So what will be the right answer? The right answer is D.
सर सेकंड इंस्टॉलमेंट ऑफ फिजिकल रिसर्च सर इस तरह से ठीक है सर
Yes. The chances of making the receiving the future payment is as it is virtually certain. That means it's already been realized.
तो 2 साल के लिए मिला ना मोटा 50 साल पहले साल के लिए होता था सर
No, actually, the training cost is a 1 day training course, and the related income should be matched with the expense in the same period. So you need to book the income on accrual basis in the same first year. Although the payment has been received the next year, but you need to book the income on the accrual basis. Because it's actually government has provided you a fund of 1 lakh rupees for this training course. So if the time period of the training course is 2 years, then you can split both the expense and the related income in the over 2 years. So the 5 lakh less 1 lakh, out of which 50,000 has been received already. Remaining 50,000 will be received the next year, but you need to book the income on the accrual basis. So we have recorded the remaining 50,000 on accrual basis. So that's why that amount of 4 lakh will be recognized in the income statement. And obviously the chances of receiving this payment is virtually certain. Okay. These all are past paper related questions. New design company is considering the following potential assets for inclusion in its financial position. Indicates which of the following options should be recognized as an intangible asset. So you need to identify which expenditure should be recognized as an intangible asset.
लास्ट वाला हो सकता है लाइसेंस जो अप्लाई किया वो भी हो सकता है
Brand name developed by the new design company. No. 2 million spent on advertising campaign. 2.5 million spent on the new equipment to develop a new successful product. It's not an intangible asset here. We're talking about the intangible asset right now. The new equipment, how can a new equipment be intangible? 3 million paid to acquire a brand. Yes, it's an intangible asset. 3 million spent on license to operate. Intangible asset. 1 million spent on the construction of the product. Prototype. That's a development stage before its launch. So it's a part of development cost. 1.5 million spent on the training customer service staff. 2 million paid as goodwill when acquired. Is it clear?
प्रोटोटाइप तो वो होता है ना जो बनाते हैं जैसे कि मैंने सारी रिसर्च कर लिया था एग्जांपल बना रहा हूं जैसे डिजाइन का होना चाहिए रिसर्च में नहीं है
No, actually
अभी तो नहीं है
okay. The prototype product will be charged as an expense. No, it should be capitalized because it's a part of development stage. Okay, I think we have attempted this question wrongly. We have done a mistake in attempting this question, so we need to read this question again, because the right answer for this question is C. We have done a mistake. 1 million is a part of research plus 0.5 million will be the depreciation part, which will be 1.5 million from project 1. From project 2, the 4 million will be capitalized and it will be depreciated from the next year, 2005. So we have done this mistake. This testing is not about the research. This testing is about the final product. Doing testing of the final product will be the development stage. New product, no? Testing a new product. The new product that we are going to launch in 2005 is being tested right now. That means we are working on the development stage. So that's why we have capitalized this amount and it will be amortized from the next year. So therefore, the right answer for this question is C. Please mark this question as C. Okay, IS 37, one of the most favorite accounting standard of the examiner, in which the most favorite accounting entry is asset debit provision credit. When we record this entry, when we record this accounting entry, when we are doing some dismantling or site restoration cost. Dismantling and site restoration cost. So it needs to be recognized at the present value initially. But from this date, we need to book unwinding of this present value amount, unwinding of discount for the provision, which will be recognized in the income statement as an expense. As well as we need to charge depreciation. On the debit side, we will be following the rules of IS 16. And on the credit side, there will be an unwinding of discount. So this is the most important area according to IS 37. And mostly examiner has asked questions from this area in which you need to calculate the full amount that has been charged in an income statement. So you need to calculate two amounts. The first one is the depreciation of the asset, and the second one is the unwinding of discount. Remember this point that both depreciation and unwinding needs to be proportionated if the time period is not 1 year. So the time period is less than 12 months, so you need to proportionate these two figures. So here is a question for you guys, in which you need to attempt the question. We should pay an estimate for you. So according to IS 37, provision will be recognized when there is a present obligation arises from the past event. Second point is the outflow of economic benefit should be at least probable. So here the percentage of making the payment is 80%. So that means that you need to book the provision. And all future provisions should be recognized at the present value. If the time value of money is, the impact of the time value of money is material. Third point is the amount can be measured reliably. So these are the 3 points that has to be met before recognizing provision. So right now the future value is 1.012 million multiplied by 0.909 will give you the 920. So we need to book the accounting entry with an amount of 920. But they have already recognized 800,000 into the income statement. So we need to book the further 120 amount into the income statement. Secondly, we also need to book the unwinding of discount. Assuming if the year end is December.
Sorry, 120 का पैसा है 100 का
Assuming if the year end is June 2008, then you need to book the unwinding of discount of this 921 into 10% into 6 by 12. If the year end is June, 30th June. That is 46. So it will also be recognized 46 PL debit and 46 provision credit. So sometimes examiner has booked part of the amount and you need to book the excess amount in the income statement. So they have booked 800,000 in the operating expense. So do remember this point that they have booked 800,000 in the operating expense. So the remaining 120 is also be recognized in the operating expense. But the unwinding of discount should be the part of finance cost. The unwinding of discount will go with the finance cost. P&L debit provision credit. Yes. Full amount. We will calculate the unwinding because 800 is not the actual amount. It's the amount that the company has already recorded. No, because they didn't book the unwinding on the 800 amount. So first we need to book the full amount of the provision, that is 920, and then we will do unwinding of discount. Past exam question. Okay, so the right answer is, you're saying it's D. Green company spends 100,000 providing health and safety training to staff. Green company has told by the brand consultancy that the value of its intelligent brand is 2 million. Green company is suing the supplier for 450,000 for the losses that it suffered due to the faulty goods. Green company is likely, though not certain, to win the court case. Not certain. Green company has sold goods subject to 5 years warranty, on which they expect some of the claim to be made. So the right answer is D. You're talking about the third one? Third option? Basically, in order to recognize the provision, there must be certain criteria that has to be met. And the second criteria of I-37 is that the chances of making the payment should be probable. So it says that the green company is likely, though not certain. So the chances of making the payment is actually less than 50% based from this sentence. We can green company is likely, though not certain, means the chances of making the payment is 50% or less than 50%. So in that case, it should be disclosed, but no asset or liability should be recognized. Flute. I'm giving a break in 1 minute. We just finish this topic first. Flute company undertakes drilling activity. Flute undertakes drilling activity and a widely publicized environmental policy stating that it will incur a cost to restore the land to its original condition. Once the drilling activities have been completed. Drilling commenced on the particular piece of the land on 1st July 2008. At this time, the flute estimated it would cost 3 million to restore the land, and when the drilling was completed within 5 years' time, flute cost of capital is 7%, and the appropriate discount factor is 7%, 0.731. So, first of all, you need to recognize the asset along with the provision and the present value of the future cash flows, which is 3 million into 0.713. 2. In millions now. What is the amount in millions? 2.139. 2.139. At what amount will the provision of the restoration cost be measured in the statement of financial position? So it is talking about the requirement is about the provision on the face of the balance sheet. So you need to you need to unwind this provision amount by 7% into 6 by 12.
0.07.
So by adding these two figures, we will get the amount of 2.21. So the right answer is D. Is it clear? Just two more questions. Now this question, please do attempt this question. What is the total charge to profit and loss? This question was examined in the most recent attempt. So what's the right answer? 6863. Yusha, Sayyida Rafia, Aisha Jabbar. The right answer is 6863. Is it clear? Six eight six three. Is it clear to all of you? Or you want me to solve it? Okay. I'm sure saying you need. Actually, the cost of the asset includes 25 billion plus the present value of the decommissioning cost, which is 6.5 6.21. 10 billion into 0.621 will give you 31.21 divided by 5 years. It will give you the depreciation for the provision amount at 6.210 into 10%, 0.621. Right? And by adding these two figures, what the amount of 6.683. Very good. This one. Now, this question, second company acquired a brand name. You need to select the right amount for the brand amortization and the training cost. So what amount for the brand amortization? For the training cost, the answer is 450. For the brand amortization, the right answer is 1 billion. You cannot revalue the brand because it's a unique asset. It does not have any active market. Are you getting this point? So simply 10 million divided by 10 years, 1 million is the brand amortization. So 1 million for the brand and 4,50,000 for the training cost. Is it clear? One question from the framework. Which two of the following statements are true regarding the conceptual framework for the financial reporting of the International Accounting Standards Board? The right answer is A and D. The right answer is A and D. Remember this point that the framework, conceptual framework is a principle on the principle based approach rather than rule based approach. The principles contained in the conceptual framework override any IFRS that exists. So it can never be happen that the framework overrides the IFRS. It requires accountants to evaluate and address the threats to compliance with the fundamental ethical principle. It has nothing to do with the fundamental principles of ethics. And if it is revised, it will not automatically lead to the changes to the IFRS standards. So if you revise the framework rules, then subsequently you need to revise the accounting standards separately rather than standards will be revised automatically. It's not possible. So let's take a break. Right now it's 1:45.
25 million जो है वो डिप्रिसिएशन की थी ना सवाल बना देंगे
Please, students, right now it's 1:45. We will start at 2:15. Okay, now we have access to the ACCA practice platform. That's the most recent past paper, March, June 2022. Now this question is related to consolidation. And the second one is related to the final account. So this is the most recent past paper final account question in which you can see that there are six adjustments that have been provided by the examiner. The first adjustment is related to bank loan. Second adjustment is related to inventories. Third adjustment is related to contracts, means related to the revenue. Note number 4 is related to the IFRS 5, held for sale. Note number 5 is related to the depreciation. IAS 16, you simply need to charge 15% depreciation. And income tax refund. There is a adjustment related to IAS 12. So right now, we are working on note number 2 from the past paper. Please solve it. So what will be the adjusting closing stock?
5560.
The adjusting closing stock is 5560. Very good. Is it clear to all of you? Didn't get the question. It says that the overall closing stock of the business is 5700. This includes some item having a cost of 700 into 1400 per unit. Well, at 80,000. And the estimated NRV will be 1200 minus 400 is the cost to completion. Sorry, 1600 minus 400. So it will be 1200 into 700. 8,40,000. So inventory should be valued at whichever is lower.
Yes, sir. 840.
It needs to be measured at 8,40,000. So what adjustment is required in the closing stock? This stock should now be measured at 840. First you need to deduct 980 and then we have to add back
840.
840 amount.
5560.
So the right answer is 5560. Is it clear? What about September, December attempt in past paper? Now this question is related to P&L, in which you are required to make the income statement and the balance sheet. The first adjustment is related to inventory. Second adjustment is related to IS 37. Third for IS 12. Fourth for the right shoe. Fifth for the investment property. Sixth for the intangible asset. And seventh for the dividend. So right now we are doing note number 1 of this question, MEMS company.
Closing inventory. Closing inventory.
Closing stock, what we have done, we have overstated the closing stock.
Minus 7.
So as we have already calculated the cost of sales, And we all knew that there is an inverse relation between the closing stock and the cost of sales. So if we are reducing the closing stock, that means that you need to add the amount in the cost of sales. So cost of sales should be added with 700. That's it. That's note number one. Note number two is about the provisions.
The cash flow debit company suspension.
So you simply need to make the double entry. Now it says the provision relates to the court case in existence since December 2004. Now here we have a provision having a value of 4600. That relates to the court case that was started in 2004. So we are going to settle this court case at an amount of 6 million. But previously we made a provision of 4600. So what accounting entry that we should have to make? Debiting the P&L account and provision account. 4600, 6000. And the balancing figure will be 1400 in the income statement. But what we have done, we have recorded the debit entry in the suspense account 6000 and crediting the cash by 6000. So what adjustment is required to correct this error? This P&L debit, provision debit, and suspense account. Is it clear? Now what about note number 3? It's an assumed knowledge that you, note number 4, that you should know how to record the right issue of shares. The accounting entry for the right issue is cash damage. Okay. So they have issued 1 for 4 right issue. How many shares do we have? 60,000. Each share is having a par value of $1. So 6 out of 60,000, 1/4 is the right issue. 15,000. The cash will be debited with the right price of 3.5. 15,000 into 3.5. 52,000. Share capital will be credited with the par value. And excess amount will go in the sharing account. So what they have done, they have recorded the cash by 52,500 I'm crediting the whole amount into the system account. 52,500. How we can adjust this error? Systems account debit by 52,500 and share capital and share premium credit with the relevant amount. Is it clear? Please do attempt note number 6. MEMS incurred a number of expenses in relation to the brands. The Indian has capitalized the following costs as intangible assets. So they have already capitalized this amount. 1.3 million cash paid on 1st April to promote one of its major brand, which is deemed to have a definite life. So it's an internally generated brand, so you cannot capitalize the amount. So what they have done already, they have capitalized the amount, so you need to deduct the amount from the asset and charge the amount into the income statement. Then it says that 2 million cash was paid on 1st October 2005 to acquire the brand from its competitor. MIMS expect the brand to have a useful life of 10 years, 5 years. MIMS intends to sell it after 5 years. At that point, it is estimated the value of the brand will have increased, and so no amortization have been accounted for in the current year. So you simply need to charge amortization because the brand is having a useful life of 5 years. The 2 million divided by 5 years into October, November, December, 3 by 12. So on the face of the balance sheet, intangible asset will be measured at 2 million less accumulated amortization, and 1.3 million and amortization of 2 million will go into the income statement. Come again? It's not a purchase one. Paid to promote one of its management. So it's a promotion of your existing brand. P&L debit. इसकी adjusting entry. P&L debit asset credit. Is it clear? Okay, so let's move on towards the topic financial instruments. Okay, is if we are acquiring the brand, then it is a purchase brand. But if you are incurring the cost to promote our brand, that means that we are trying to create the brand name internally. 1300 PLM, yes. Okay. The financial instrument is a contract. Remember this point that financial instruments are contracts that give rise to the financial assets of one entity and financial liability or equity instrument of another entity. So all contractual financial assets or contractual financial liabilities should be covered under the scope of these accounting standards. The first one is IS 32 and the second one is IFRS 9. The financial assets includes cash, equity instrument of another entity, contractual right to receive cash or other financial asset, and the exchange of financial asset, financial liability which are favorable. Similarly, financial liabilities is the contractual obligation to deliver cash or another financial asset, and contractual obligation to exchange financial asset or liability on unfavorable terms. So these are the definitions of asset and liabilities. So you should know all these definitions so that examiner might ask you the question related to these definitions in section A. Now, how are you going to measure the financial liabilities? Financial liabilities are initially measured at the amortized cost, and it's a default category for all the financial liabilities. But if the financial liability is held for trading purpose, then it will be measured at fair value through P&L category. In recording the financial liability, we first need to deduct the issue cost and the discount from the formish value, from the par value of the loan. Then there is a concept of equity or liability. Therefore, we always recognize redeemable preference shares as liability because they have the obligation to repay the amount, and irredeemable preference shares as equity. So the dividend of this category will be recognized as a finance cost, and the dividend of this category will be the part of retained earnings. For the compound instruments, IS 32 says you need to follow the split accounting. Split accounting means initially you need to separate the amount of liability and equity. Then subsequently this liability needs to be amortized. And the amount of the equity option will remain the same. Financial instruments could be debt instrument or equity instrument. If we have an equity instrument, then it could be measured at fair value through P&L category or fair value through OCI. Remember this point that we always charge transaction cost here as an expense, and here the transaction cost needs to be capitalized. The gains and the losses in fair value P&L category will go into the income statement, and the gains and losses on the measurement under fair value through OCI will go under OCI. That's very simple. For the debt instrument, we can measure at either amortized cost fair value through OCI and fair value through PL. Which one is the default category? Fair value through PL in this case. Okay, it's very good. So how and when we can measure the debt instrument under amortized cost method? When there are the two tests that has been passed. The first one is business model test. The second one is cash flow test. business model test is passed when
Uh,
when
hold it until maturity.
when our intention to hold the investment up till maturity. But if our investment, our intention is to hold for some time and then sell it subsequently, then the business model of the OCI will be passed. So the basic difference between these two tests is, in the amortized cost, you need to measure the investment till the maturity date. But under the fair value through OCI category, we need to record this for some time and then subsequently sell at a future date. There is a cash flow test in both the cases. It says your future cash flow should be based on the principal amount and the interest amount. No other item other than these two should be the part of the cash flows in the future. Then your cash flow test is passed. If you will not get admission in the amortized cost or the fair value through OCI, then you can place the investments in that instrument under fair value through P&L. All the gains and losses will be recognized in P&L. Under amortized cost, remember this point that you need to capitalize the transaction cost. And same for the OCI. The first question for you. So this question is about the financial asset because it says that we have acquired the bonds. So you simply need to measure it using the amortized cost method. Financial asset at start initially at 9,400. Plus finance income will be effective rate. It will be 9,400 into 8%.
7.
The Sept will or the payment will always be made at the nominal rate into the par value. This will go as finance income into the income statement. And this will go as a financial asset. 9702. Is it done? No. Please solve this question. You also required to calculate the gain on this financial asset. The right answer is the right answer is 65250 for, and the loss that will be recognized in the OCI is 1350. Is it clear? So in this case, 4% is totally irrelevant because either we select the fair value through PNL or fair value through OCI. At each reporting date, we need to check the fair value rather than cost to sell. So this standard has no provisions for the cost to sell. So therefore, this 4% is irrelevant. So this is our normal practice that we try to adjust each and every component that is available in the question. Yes. Loss because we have acquired the shares for 9,000 into 6.4 plus 9,000 is the cost that we have incurred. So it's 66,600. And this is now worth 66,250. So there is a loss on holding these assets.
Concept transaction cost capitalized with you.
Yes, in the OCA category. Now please do solve this question in which you are required to split from the convertible loan figure the amount of the liability and the equity. So in order to split the amount between the liability and the equity, first you need to calculate the estimated future cash flows of the loan. The life of the instrument is 3 years. The future estimated cash flows will be 250, 250, or last year principal plus interest amount 5250. Discount rate, we always use the discount rate of the similar loan without conversion option. 0.93, 0.86, 0.79. This will give us the present value of the liability. Present value of the liability is 4595. The difference will be the equity option 405. Very good. This liability component needs to be amortized over the future periods. Interest will be based on the 8%. Very good. Payment will be made at. Very good. 47. That's good. So in the income statement, we need to book a finance cost of 368. And on the face of the balance sheet, there will be a non-current liability of 4713 along with the equity option in the equity section of 405. Is it clear? So that's the end of today's session. I'm giving you just basic introduction of this concept factoring, which the factoring company can provide you with recourse arrangement or without recourse arrangement. With recourse arrangement means the risk of the bad debt will be borne by the company. And without recourse means will be borne by the factory company. So with recourse means with risk, without recourse means without risk. So in this case, whatever amount initially you receive from the factoring company should be recognized as a loaner. And in without recourse arrangement, the whole of the amount will be recorded under the receivable account. The accounting entry could be cash debit or debtors credit. The debtors receivable needs to be de-recognized. And in this case, whatever amount you receive should be the part of the loan. That's it. Here's a question for you, which will be the last question. That's the last question. So the last question is, so from this information, will you be able to identify who is bearing the risk of the bad debt? It's a company. So whatever amount that you receive from the factoring company should be the part of the loan. That's it. And when we recognize the loan, you also need to book the finance cost if the rate was available. In this case, there is no rate available, so that's why we are not recording the finance cost in this question. So that's the end of today's session. We have covered IS2, IS38, IS37, IS20, and IFRS 9, IS32. And tomorrow we will be focusing on the key changes that can be examinable in this session, September attempt, and we'll be focusing on practice platform along with IFRS 15, IFRS 16, and IS 12. IFRS 15, IFRS 16, IS 16, IS 12. Okay, Allah Hafiz.